The Opendoor Technologies Inc. stock is currently closed at $7.97 as of the last trading session on Friday, October 24, 2025, showing a significant intraday movement of plus $0.94, or a plus 13.37% increase from its previous close. Now, everyone sees that headline jump. 13.37% in a single day, an eye-catching move that naturally fuels the narrative that Opendoor has finally broken free of the gravity well that is the high-interest rate real estate market. The common expectation is simple. This must be a technical bounce, a sign that the worst is over for iBuying, and perhaps a preemptive cheer for an anticipated easing of the macroeconomic pressure cooker. But the reality is much more interesting and arguably more volatile than a simple rate cut hope. That massive one-day pop wasn't just driven by an abstract optimism about the Federal Reserve's long-term plan, it was directly tied to a cooler-than-expected inflation report, specifically the September Consumer Price Index, CPI, coming in slightly below forecast. This immediate connection between a micro-cap, highly sensitive real estate stock and a major macroeconomic indicator tells us the trading isn't about Opendoor's immediate operational excellence. It's about the market treating this stock as a leveraged bet on interest rates and housing market liquidity. That positioning means the stock is not just swinging, it's on a hair trigger, reacting disproportionately to any whiff of change in monetary policy. That's a critical, often missed nuance. It's not a steady climb based on fundamentals. It's a speculative lurch driven by macro sentiment, making it a darling of high-volume retail trading, akin to what we've seen with other highly volatile names that capture the attention of online investment communities and self-investing platforms like Robinhood. The general belief among casual investors, especially those active on Robinhood app forums, is that Opendoor, being a tech-enabled real estate company, has successfully weathered the storm and is now simply waiting for rates to drop back down to a housing-friendly level to see its model truly shine. The promise of Opendoor Technologies Inc. has always been instant liquidity for home sellers, disrupting the slow, painful traditional model. Investors saw them as the future, the Tesla stock of real estate transactions, a company using data and software to make a deeply analog business digital. But the contrarian deeper take is that this stock's wild volatility, including its massive year-to-date return of over 400% from its 52-week low, contrasted sharply with its huge decline from all-time highs, tells a story of a company whose business model is fundamentally exposed to cyclical, macro-driven risk in a way pure software companies like NVIDIA stock simply aren't. Opendoor makes its gross profit on the spread, the difference between the price it buys a home for and the price it sells it for, minus holding and repair costs. When interest rates shoot up, two things happen. The selling cycle slows dramatically, increasing holding costs and inventory risk, and home prices soften or decline, crushing the profit spread and leading to potential losses on inventory. The fact that their stock is rallying on macro news rather than news about improving their pricing algorithms or operational efficiency reinforces the challenge. Their fate is currently tied more to the Federal Reserve's next move than to their execution. It is a macro play masquerading as a tech stock, and that is a massive distinction for anyone trying to navigate their portfolio, whether through Fidelity's guidance or their individual brokerage account. Looking at the most recent stock movement, the sheer volume spike on Friday is hard to ignore. The trading volume was enormous, well over 200 million shares, significantly higher than its three-month average. This kind of volume indicates a huge influx of activity, likely from both institutional players covering short positions and retail traders piling in, chasing the momentum generated by the CPI relief. It is worth noting the high short interest, sitting around 22% of the float. A short interest figure this high means that any strong positive news, even macro-related optimism, can trigger a short squeeze, where short sellers are forced to buy shares to cover their losing positions, further amplifying the price increase. This is precisely the kind of dynamic that creates the massive swings we've seen, like the one in September when the stock registered an astonishing 79.5% single-day climb, cementing its status as a meme stock favorite. The current price is still trading significantly below its 52-week high of $10.87, which occurred just last month, but the recovery from its brutal 52-week low near $0.51 is nothing short of breathtaking. However, this recovery isn't fully supported by recent financial reports. The company has been in an intentional period of right-sizing inventory and tightening its purchase criteria to mitigate risk. This focus on de-risking has meant lower revenue. The last reported revenue was still high, around $1.56 billion, but the company is not yet profitable, posting net losses. The new CEO, Kaz Nejatian, coming over from a strong operational background at Shopify, has been vocal about leveraging artificial intelligence to improve their pricing models and increase operational efficiencies, which is the core long-term hope. This focus on AI to better predict home values is the company's internal counter to the external market volatility. But these are long-term projects, and the daily swings are driven by much more immediate, primal market forces. Institutional activity, which we track through filings, shows a mixed picture. Some smart Fidelity investments and other major institutional funds are accumulating shares, viewing the beaten-down price as a deep value play on a future housing recovery, while others are offloading, citing continued inventory and macroeconomic risks. This tug-of-war is what creates the churn and volatility. For those using interactive brokers or a similar platform for advanced tracking, the technical indicators following the recent surge are flashing very mixed signals, reflective of a stock that has moved too far too fast but still has strong momentum. To understand why Opendoor is so exposed, we have to grasp its core business model. Opendoor is an iBuyer, or instant buyer. Their process is simple. They use a proprietary pricing algorithm to give a home seller a cash offer, usually within 24 to 48 hours. If the seller accepts, Opendoor buys the home, handles minor repairs and renovations, and then resells it. They get paid by charging a service fee, the spread, and hopefully making a profit on the appreciation and renovation work. The entire model hinges on three things: pricing accuracy, inventory turnover speed, and low cost of capital. When interest rates shoot up, all three of these fail. Pricing accuracy becomes a nightmare because traditional valuation models break down under rapid rate hikes. Turnover speed plummets because fewer buyers can afford a new mortgage, and the cost of capital, the money they need to borrow to hold hundreds or thousands of homes, skyrockets, turning inventory into a crushing liability. This is why the stock collapsed in 2022 and 2023. The common investment thesis that failed was the expectation that their algorithm was immune to market cycles. The reality was that no algorithm can accurately predict a sudden, massive shift in central bank policy and its direct, punishing effect on real estate valuations and liquidity. The older reports, from late 2022 and early 2023, were grim, showing significant losses as they sold homes at a discount just to flush the inventory and stop the bleeding of holding costs. This operational cleanup, which involved massive inventory reduction, has allowed them to stop hemorrhaging cash and is the primary source of the recent optimism. They've proven they can survive a housing crash, a brutal survival, but survival nonetheless. The comparison to competitors like Zillow, which essentially shut down its iBuying operation, is a point of pride for the bulls. Zillow realized its model was unsustainable and pivoted back to being a listings and service company. Opendoor stuck with it, claiming their commitment to the core model, albeit a revised and risk-mitigated one, will pay off when the cycle turns. The revised model involves a greater focus on agency partnerships, essentially integrating their platform with the traditional agent model to still offer their liquidity and certainty to sellers who prefer to work with an agent. This pragmatic shift from pure disruption to disruption as a service is a much more mature and less risky approach. It shows management is learning from the market's lessons. For individuals using online investing tools from places like Fidelity or SoFi Invest, this pivot makes the long-term proposition slightly more palatable, as it reduces the all-or-nothing nature of the previous strategy. The company's financial health, while still showing losses, has seen improvement in unit economics, which is the key metric to watch. Specifically, they are narrowing their contribution margin after interest, showing they are losing or even turning a small profit on each home sale. But a small profit per home can still be overwhelmed by massive overhead and corporate expenses, which is the final hurdle to profitability. Now, looking ahead, the future outlook for Opendoor is a tension between two distinct scenarios. The first, the optimistic expectation, is that the CPI relief we saw translates into a prolonged period of central bank rate cuts starting in the next few quarters. If mortgage rates drop from the current high single digits back towards the mid-4s or low 5s, Opendoor's model gets its oxygen back. Buyers return, home prices stabilize or appreciate slightly, and most importantly, Opendoor's inventory holding costs and time shrink dramatically.